Are you backing someone who wants to build a venture capital firm? Or are you backing a particular economic opportunity? From a very tactical standpoint, is this deal flow something that we can see yielding some economic returns in the near term? Do I want to write one check into one person, or do I want to continue to invest in this person and their companies for a long time? And that's two different exercises.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Ben, welcome. I will say this has been a long time in the making, and this is an understatement to say that how excited I've been for this conversation. And so I'm going to give a little introduction to kind of set the stage here, and we'll dive straight into it right after. So Ben Ehrlich is the founder and general partner at First Momentum Capital, a fund of funds dedicated to backing the next generation of venture capital funds. He is also the director of strategic initiatives at the Long Term Stock Exchange, LTSE, an institution founded by the amazing Eric Ries, built, as the name suggests, for long-term time horizons across capital markets, including startups in the private markets. Ben's also got this amazing set of wild experiences from growing up in Toronto, DC, Michigan, England, just to name a few, to having lunch with Bruce Springsteen. Prior to First Momentum and LTSE, Ben's been working in the world of marketing and PR alongside clients like Andreessen Horowitz, Airbnb, TurboTax, and more. Ben is also a proud graduate of the University of Michigan, Go Blues, with a degree in political science and government, and also a proud dad of an Irish doodle. We'll need pics of your doodle later. We cover a lot of ground here, from talking about how First Momentum Capital was started to what it's like working with Eric Ries, as well as deal flow as a function of the future. Yes, that's a teaser. We will talk about it a lot more in the episode, but teaser for now. And also, we also talk about the 5 promises Ben makes to the world with respect to deal flow. So it's a lot to go on, but without further ado, Ben, welcome to the show.
Well, thank you, David. It's been great, and you've had some real legends, some people I really look up to on here. So I'm just honored, and I have to question your judgment a little bit to having me on, but we'll just take it from there.
I wouldn't question my judgment. No, I do question my judgment quite often, but at least in terms of guest picking, it usually comes in the world of like hundreds of people, like not hundreds, but a lot of people do recommend certain guests to me quite often. And your name has come up multiple times, which is why I'm really excited for this as well. And in talking and doing a couple reference checks, if I might call it that, for this conversation, you've got a great set of friends out there.
Well, thank you. I think, again, I'm very lucky to have gotten to the position I'm in, and I'm lucky to have people who will vouch for me. And I will vouch for all the people that I know you talk to. I vouch for all of them 10 times harder.
Some of those names will come up in this conversation because they've given me permission to use their names. But
Fantastic.
As a place to start off, to scratch my own itch here, but with the Out of the Crisis podcast. As someone who's definitely got more miles on your odometer compared to this rookie podcaster asking this question, could you walk us through the behind the scenes of producing Out of the Crisis podcast? Like, how did the idea for it come to be?
So I can't take the full credit for the idea, but I was very lucky to get to work on the show. But the idea really came out of the early days of COVID. March 2020, April 2020, when it basically felt like every time, you opened Twitter, every time you looked on any news site, the world was ending in a different way. I don't know if you remember the murder wasps. I think that was sort of the last straw for us. And
I do remember that.
Yeah, I don't know whatever happened with them, but hopefully they're not still out there. But the person that I work with and work for at LTSE, Eric Ries, he and I were talking, and he was sort of saying, look, like, I'm coming across all these amazing people who are doing, getting food to people who need it, and, funding these massive initiatives and bringing, tons of PPE into the country. I don't know why these stories are not being told, but, we should really get them out there. Or I think the statement actually was, someone should really be telling these stories. And we were sitting down, and it was like, Eric, you've got 300,000 Twitter followers, you've got hundreds of thousands of people on your newsletter, you've got this amazing brand, like maybe you should do it. And so, that was really the idea. And the idea was, okay, let's ask a couple people and just see if they'd be willing to come on the show and talk about, the stuff that they're doing. So, sent a note to someone who I think everyone in the venture world knows now, Sam Altman, and said, hey, we've got this crazy idea for a podcast. Would you ever consider doing it? He replied in about 20 minutes later and said, yeah, can we hop on tonight? This is exactly what we need to be doing. So, I can't take credit for that. Eric has these amazing connections out there. And, Eric turned to me and said, do you know how to make a podcast? And I said, no, but let's figure it out as we go. So we got plugged in with a great team at Breaker. Eric Berlin, the CEO at the time, before they got acquired by Twitter, was a phenomenal partner throughout it. I think they're some of the best audio people out there, and really just kind of got going. And anytime we'd come across anyone with something positive to say, we would just interview them for at least an hour. Eric did a great job interviewing people. I was figuring out, if you listen to the first couple episodes, they sound terrible. They're edited really poorly because I was running it. I was doing it off of my iPad. But over time, we really built up a process. And, I think we were getting a couple 100,000 downloads at the peak episodes, and hopefully made some people, feel a little bit better about the world at a time that felt pretty dark, because that was really the goal. So, yeah, that's kind of the story. Maybe one day we'll pick it back up. Hopefully, maybe if there's not another crisis, but there probably will be, so we can pick it back up at that time.
To scratch my own itch here, just to help myself as I'm starting writing this podcast, and I know a lot of our LPs in the audience also are working to start their own podcast and or have started already. What does the process of editing and producing a podcast for the first time look like? Were there rookie mistakes you made in episode 1 through maybe 5 that you've learned, like, hey, you know what? I'm no longer going to do that ever again?
Yeah, I think the biggest thing that I learned is that it's worth paying professionals to do things that need to be done by professionals. So in the first couple episodes, I was like, oh, I can do audio editing. I can do, I can do all the production. I can, add in all the music and do all this type of stuff. And if you listen to it, it was a bit of a disaster. It took me 6 times longer than it should have. I ended up accidentally deleting all the audio at one point, and then I had to figure out a way to get it back. So there's a lot of great, there's great audio editing. And, my brother is a audio producer. And he was telling me, dude, I have a whole degree in this. It's not so easy. I was like, no, I can figure this out. And so for episode 2 and plus, we, there's great audio editors, there's great people, whose whole business is producing and setting up podcasts. And, I always say, make sure to pay the government and your doctors on time. I'm going to add that to your podcast producers. Make sure to pay doctors, the government, and podcast producers on time, because they're, they really know what they're doing.
That makes a lot of sense. This is why I have an editor and I'm not doing it myself. Someone who's been around the block a couple of times. I would take so much longer, even if I were to produce some semblance of quality. To switch gears here, you did mention a particular name which we'd be remiss not to talk about in this episode, Eric Ries. How did you first start working with Eric? And I mean, whose reputation precedes him? I'm sure you knew that as well. And I particularly love the story you've shared, but I think you've only shared the side of like, what was your reaction to it? But how did you guys first get in touch? How did you first reach out, or how did he first reach out? I couldn't find that in the homework for this conversation.
It really all comes down to some cold emails that I sent. And, I think cold emails have played a really important role in my life, just being willing to just send an email and say, I'm going to say something nice in this email. And hopefully the person, the worst thing the person does is delete the email. So at the time, I'd been following, I'd read The Lean Startup, as any person who thought that they were going to build, the next Facebook, when they were younger, did. I'd read, all the business books, and Lean Startup was one of my favorites. And I've been following LTSE for a really long time. They were a client of OutCast's, where I worked briefly after college. And, I just thought it was a really interesting model. And, I was kind of like lost in my life. And I realized that I was at Columbia for grad school at the time. And I remembered that one of the board members, or one of the sort of early employees at LTSE, was also a professor at Columbia. So I just sent her a cold email and said, hey, I followed LTSE for a long time. I really, like these points. I just wanted to say, you guys are doing really awesome things, and, keep up the good work. Didn't hear anything. Sent probably, 2 or more of those notes to her. Just anytime there was, some news that I thought was really interesting, I would just send, hey, this is really a positive note, or, those types of things. And eventually I was looking, I was trying to figure out what to do with my life for the 600th time before age 22. And I, basically dropped her a note saying something like, hey, if there's ever any positions, within LTSE, I'll sweep the floors. I don't really, I don't need anything fancy, but I, would just really love to be a part of the journey. And didn't hear anything for 2 days. And then I got this call from this number I didn't know. And I happened to pick up. And it said, hey, this is, his name was Steve Gold. Hey, this is Steve Goldstein. I work with LTSE. Eric Ries is in town tomorrow. We might need you to come down and do some work with him. How fast can you be in Midtown Manhattan to sign an NDA and a contract? So that's really it. I met Eric. I met Steve. He interviewed me for probably an hour and a half, and he looked at me and he said, "Look, you're not ready to do this job yet, but you will be in 6 months, and we can't afford the person that can do the job right now. So, you're hired." Met Eric the next day, and then that was almost exactly 6 years ago, 5 years and 11 months ago today. Eric and I still work together, and it's been an absolutely amazing journey. I've learned so much from him, built so much from him, and can just say that I can't have imagined working with Eric and Steve. I can't have imagined two people to learn from and be treated just with the best respect. And I'm still very lucky that I. At 3:00 in the morning one day, remembered that someone at Columbia happened to work for LTSE.
I'm curious, and feel free to leave this up to speculation. But when Steve told you you're not able to do the job now, but you're gonna be able to do it in 6 months, what qualities do you think he recognized in you, and what questions were he asking you for him to see that, hey, Ben is able to do it in 6 months?
When Steve interviewed me, it was one of the weirdest interviews I've ever been in. Because there was almost no questions about the job. There was almost no questions about me. He sat across the table from me and just started asking me about scenarios. And these are not like McKinsey, how many light bulbs are there in Manhattan type questions. These are,
Right.
If you were sitting in this situation and you noticed your boss doing this, how would you react? What would be the questions that you would want to ask? How would you do this? And that would, probably an hour and a half of just nonstop. I asked at one point, I said, "Hey, can I get a glass of water?" And he said, "No. No, we need to solve this right now." And I think, and I asked him this actually recently, and he said, what I liked knowing is that in the beginning you were really nervous and you weren't sure the right answers, but you got better as it progressed. And you got more confident as you realized that, I was actually trying to help you figure out what the right answers were. And he said, from the amount of growth I saw in that hour and a half, if you can continue even at half that rate over the next 6 months, you'll be ready. You'll be ready to go. And he said, the other thing that he said is, look, I need you to trust me. Because my first day with Eric, I was completely overwhelmed. There was so much going on. There were so many names being thrown around. We went to the top floor of one of the most famous buildings in New York City. I don't want to say which one, but met a very important person. I was like, oh my God, I signed all these documents 6 hours ago. Now I'm in this meeting, and I was completely overwhelmed. And Steve said, look, I bet on you, and Eric's betting on you because we know where you can get to, and I'm going to help you get there. And so, having someone say that to you, having someone, really be that first believer and even tell you that you can do something is, a lot of times that's what people need to hear. And that's definitely what I need to hear.
In general, like for someone who wants to be a fly on the wall in some of these conversations, because these are in the hallowed halls of like Long Term Stock Exchange and all that, and your team, how do some of these conversations play out?
We've covered a lot of different things. I've worked with Eric and Steve for 6 years, and we've worked on an infinite number of projects in that time. So I don't, I can't break it down exactly because each one's a little different, but I can talk about the principles that we use to solve problems. We talk a lot about, there's a Jeff Bezos saying, which is, one-way doors versus two-way doors. If we can assess, is this a decision that we can easily fix later, right? That's a two-way door. You can always come back from it. We try to make the decisions very, relatively quickly. Not that it's not thoughtful, not that we don't think that it's going to turn out, but we always make sure that, as long as we can reverse the situation, let's go figure it out. Let's test it. Second, and this is going to surprise no one, Eric wrote, the seminal book on what an MVP is, the lean startup, is try to say, okay, what is something that we can use to get more information? Let's design an experiment. Let's run small batch sizes. Let's ask the 5 whys. And for anyone who hasn't read the book, you should go read it because it's really, really good. And you'll understand what I'm saying here. There's a really high degree of trust between Eric and myself, and Steve and Eric, and myself and Steve. And you can't, I think that, and this is going to get to your point, this is going to get the point that when we start talking about LPs is that there has to be a high degree of trust, because we're talking about very high leverage things that if they go well are going to have huge impact in a positive way. And you want to understand how that's going to play out. And if they go poorly, is going to be, very difficult. So you need to have a high degree of trust to really make sure that you feel like you've said everything you need to say, because both those outcomes are possible. Particularly at high leverage opportunities. So, each conversation plays out a little bit differently depending on the situation. But I think like when you kind of approach things with those principles, particularly, starting from a place of understanding what type of decision you're making, understanding what process you're trying to use to reach the decision, and making sure that, everyone in those situations has a really high degree of trust with each other. I think that's where you get, that's where the magic starts to happen.
I love the idea of trust. And for those that are curious out there, how does one go about establishing a high degree of trust? Because even in the early days, when you first joined LTSE, Steve told you, hey, this is going to be tough. There's going to be a lot of things that are thrown at you, but just trust me. For you, was it instinctually like, okay, I will trust this person who I've been competing with for an hour and a half in like my early conversations with him? Or was there something else he did or said or made you read or write that helped you better trust him in the early days?
So the answer to that is that there was no one thing, because I don't believe that trust can be built in an instant. It was a series of, it is a decision to trust someone, and it is a decision to build trust with someone. And it's conscious and it takes work. But, my decision was, well, I don't have any other opportunities. And, I'm going to trust in myself to be able to do this. And this person is saying something to me that no one has ever said to me before, which is, you need to trust me and I'm going to help you get to where you need to go. And I said, well, worst case scenario, this is an awesome learning experience. Best case scenario, I found some people that I can work with for a very long time. And luckily it's been the best case scenario. But I think it's a conscious decision. It's like, I'm choosing, when you trust someone, you are choosing to give up some control. And that's a really hard thing for us to do as humans. And there's lots of psychology books. I'm going to try not and quote too many books here. But there's lots of psychology books about, control and all that type of stuff. And when you give up control, it's very stressful and scary. So yeah, it's a conscious decision you have to make. And you also, but that's reciprocal, right? It's like, I'm giving up some control to this person who's going to kind of take some control of my life, but then they're going to show me reciprocal in the way that they're going to give me some of their control. Right. And the biggest thing that I found too, this is very, very tactical. If you want to build trust with someone, if they screw up, you have to be okay with them screwing up. Because you put them in a situation. If you delegate something to someone, or if you work with someone and they screw up and you're saying, look, trust me, I'm going to get you where you need to go. You have to be okay with it, and you have to make sure that they feel okay with it. Not that you want them to continue to screw up forever, but that is the fastest way to burn relationships and to burn trust, is if you start to go after people for making a mistake.
In learning how to establish a high degree of trust with your team members at LTSE, are there any lessons that you've taken away and use it in terms of first momentum, as well as establishing trust with GPs in the first few conversations?
A couple things. One thing is that I always say is like, I like to see the process. I like to see all the messy materials. And I'm in a very lucky position where I actually get to meet a lot of the managers that I meet. They're not even managers yet, right? They're people who are just thinking about raising a fund. They maybe have a deck, but they're not really sure how to do it. And like, I think what I've tried to do is really, say, look, show me what you have. Even if you don't think it's ready, show me what you have right now, because I'm going to help you make it better. Even if we don't invest, even if we don't, even if it's a real estate arbitrage fund in some country or on the moon, right? There was a fund that was buying land on the moon, funnily enough. Let me help you, and let me give you, I'm going to open up with you and share my experience and share, my thoughts with you. And, if you reciprocate and you are willing to work with me on that, and, that's a great way to establish a lot of trust. And I think, that's actually, the thing. Our mutual friend, Arcady, and I don't know if we're going to talk about him. I don't know if I should be mentioning his name, but I'm assuming it's fine.
I'm sure he'll love the press as well.
Yes, Arcady, RPV, everyone should take a look at it, doing amazing, amazing physics-related things. The thing that really impressed me about him was it was that instant rapport, and it was an instant case of, I looked at his, some of his. I mean, I met him before he even started the fund. We were talking about his materials, and we just built up a really good reputation, repertoire. Sorry, back and forth on that type of thing, and it just shows you. It shows you how someone takes feedback. B, it shows you how someone learns, and C, what Arkady said to me was at one point was, "Hey, I understand what you're saying, but I disagree with that, and I'm not going to do that." And I was so happy to hear that, because I'm like, look, he's now established his own expertise, and now I can learn from him. And then you just create that constant dialogue. And so, I think just being willing to really engage with people is sort of the first step, and being willing to not just, to understand on some degree, as an LP and as an allocator, the GP is pitching you, but also you're pitching the GP and say, look, if you let me into this fund, what type of partner am I going to be? What type of investor am I going to be? Am I going to be on your side, and am I going to be that supporter of you? Or am I going to, be someone who's imperious and, really being difficult throughout the whole process? Because people show you who they are. You just got to, pay attention.
I completely agree. And for those that have not looked into RPV, I find them to be absolutely incredible in many different wavelengths. They have a very clear rationale for everything they end up doing. One of my favorite things, and to give a slight peek under the hood, because I think I've alluded to this in a blog post already. So Arkady, if I'm going to send this to you later and you say I cannot talk about it, do let me know. We'll cut this part out. But the decision-making process is very, very, very granular when it comes to RPV, to a point when I'm like, how you see those like checks and balances things, like, oh, if this happens, yes or no, right? If no, we go down this decision-making tree. And if we say yes, this goes down this decision tree effectively. Imagine that on steroids. And it is by far the most elaborate branching like set of decisions that I've ever seen. I'm like, holy cow. And I think this is, I might be misremembering this. If I'm putting words in your mouth, Arkady, please let me know. But I was like, if an associate were to take those same decision trees, they could probably get to like 80 to 90% similar proficiency. And I found that, one, in terms of scalability and succession planning, to be extraordinarily insightful.
One of my big beliefs, and we can get into this when we talk about looking at investors, is, investing is a art form that gets better by discipline. Right, you get better over time by building discipline into your process, but at some point, you have to have that intuition. You have to understand that art, and that's what's so wonderful about, he's got that beautiful chart. Again, I don't know if we're going to be able to actually talk about any of this, but he's got this beautiful chart that really lays it out and says, look, this is our discipline, and this is going to get better, and we're going to continue to improve on this. And to your point, you're right. Someone could get to 80, 85%, and then it's that additional 15, 20, 15%. That where that intuition comes in, and that's the real magic, particularly at the early stage, particularly in deep tech, particularly in venture, where that's where you start to see the magic happen. That's when you start to get really excited about someone.
And I know also, this is going to be a fanboy session for Arkady. I really do. I love him so much. But also the way he thinks, RPV invests in deep tech. Deep tech in its own right is a very broad industry altogether. And the way he spells it, I'm sure you remember this, Ben. There's a specific slide in his slide deck where it spells
slide 3.
out. Yes. Oh my
slide
God.
3.
Yes.
I reference it all the time.
I do too.
I reference it all the time.
And for those curious, I did write a blog post on this, and I do have he has allowed us to share the TRL levels. So TRL stands for technology readiness levels, which were a set of systems and an understanding created by NASA. I want to say in the 1960s, but it might have been sooner than that. So don't hold me to that date in particular. But it's to understand, for a certain piece of technology and for a certain piece of innovation, how far along the commercial viability process or like technologically ready process is it? And for Arkady, they invest in a very particular segment in the TRL levels, which I've never seen anyone spell out deep tech in the same way that Arkady has. So naturally, Ben and I are both big fans of Arkady, and for multiple reasons. I want to say we both put our money where our mouth is worth, at least for...
Absolutely.
Yeah, we can talk about that, right? We're both proud LPs.
Yeah. Oh, yeah.
This is fascinating. So switching gears onto the kind of the world of, I don't want to touch a little bit on first momentum before we get into the nitty gritty of things, but how how did first momentum start? How was the what was the conversation like
Mm.
with Eric and the team to arrive at first momentum and for them to be like, hey Ben, this is really going to be your next chapter and you should totally pursue this.
Yeah, so it comes from a conversation that Eric and I actually had on day 2 of our working together.
Oh wow, early
And
on.
then I'm going to fast forward the 4 years, which is, Eric said, look, I do a lot of things and I have a lot of different people in my life. And my goal for you, when you come on and start working for me is that I can hand off some part of my universe to you. I build trust with people. I want them to succeed. I want them to feel like they can either go start a company or, that they see something that we're doing and we get to go do it together in a different way, or, we get to build out different ideas. And again, amazing that someone's saying that to you and actually, and then actually delivered on it. So it started with some, a realization that we had, which is, we were looking at the world and seeing a lot of people start different venture funds, and looking at, Eric's personal investing and we were just kind of doing a general exercise where it's like, he was like, I have no idea how any of my investments are performing. I have no idea, how any of this type of stuff does. Ben, if you're interested, would you want to take a look at, this was probably 3 years ago at this point. Would you want to just take a look at everything and just tell me, what's going on, and just tell me, what the interesting things are in this? And I was like, are you kidding me? I get to have the angel, I get to look at the angel investment track record of one of the, great people in Silicon Valley, and had an amazing data set to work with. And one of the things I took away from his track record was, I was like, look, you've an amazing track record, right? The investments are very strong on their own, but there's actually this interesting subset within what you're doing, which is this, you are oftentimes, and I was looking at all the different sort of materials at the time, and I was like, you are oftentimes the very first check into a lot of these different new funds. And Eric was like, oh yeah, I do that as a public service. I have friends who are, starting different venture funds, or I see things, interesting strategies, and I'm always happy to put my name on it and, be a stamp of support. He views it as a sort of a very, an ethical thing to do and the right thing to do for the tech ecosystem, which it is. And I was saying, no, take a look at this. It's actually one of the best performing pieces of your portfolio. It's actually this own little asset class within the venture ecosystem that's really, really interesting. And I said, and the other interesting part is some of your best performing later stage investments, right? Because he would write sort of slightly larger checks into Series C, B, C companies. The best of those are actually coming from co-invest deals that these funds are at. So, that was an insight that we had, and then we did a ton of research. There was actually about that time that the Cambridge Associates data came out showing that Fund 1 and Fund 2 are some of the best performers from a TVPI perspective over the past 20 years, and there was this interesting. There was this new interesting data coming out in the venture ecosystem. And Eric and I helped do some of these deals with his personal capital, and then I actually, I was enjoying it so much. I was meeting so many interesting emerging managers, and and the returns were looking strong. But it was also this itch that you have, where it's like, look, I actually really enjoy working with these people. I think that there's a need in the ecosystem to be a first mover into some of these funds, to be a good citizen, to not waste people's time, and to just really try and fill a gap. And I actually like doing it, and there's economics behind it. And I actually went to Eric and I said, look, I think I need to go off into the world and do this, and start my own thing, and plant my stake in the ground and try and build this. And Eric looked at me and said, well, that's kind of silly. And I was like, what do you mean? And he goes, well, why would you want to go off on your own? Why don't we just do it together? And I'll invest, and I'll bring some people in, and we can actually go build this thing together. And instead of you having to start on your own, we actually we get to be amazing partners in this. We already know we work well together. Why don't we do it together? Which was the biggest vote of confidence I could have received. And that's really the idea behind First Momentum. We had some amazing sort of angels back us, in the first round of funding for it. We've raised some more capital from different folks, and done, all last year, done 7 deals, going to do a few more. And, every day I wake up and I'm like, man, I can't believe that, not only do I love the stuff I do with LTSE, but I have this emerging LP bucket that it brings me joy every day, and it's going to make money, and it's, going really well. And so, people always ask me, how do you get to where you're at? And I'm like, I have no idea. I'm just really lucky.
You are too harsh on the preparation it took on your end to get to where you are. And what is that Seneca line? And I don't want to misquote it, but I believe it's like, opportunity is when luck meets preparation. And so there's a combination of both. What was the pitch, if you remember? What was the pitch for angels who ended up investing as emerging LPs in First Momentum's Fund 1? Like, what was the sell to them that made them believe in what you guys were building?
It was one pitch that different parts of it appealed to different groups. And so, our investor base is sort of consistent of two groups. One are, people who have grew up in Silicon Valley, understand the ecosystem, understand both the benefit and the economics opportunities that arise from this. And they also are getting pitched to these people all the time, and they need someone to help manage that. So that's sort of one piece of this. And the other piece of it is people who are incredibly sophisticated investors and for whatever reason hadn't allocated to venture yet. And so, we are very lucky to get to work with a number of these groups where I learned so much every time I'm talking to them about, either options trading or real estate or prop trading or any of this type of stuff. And then, we get to return the favor and help, and talk about venture and sort of be that educational partner. But the pitch is really straightforward. It's that, venture is a very capacity constrained environment. And so, the very best established funds, there's no capacity available. And there's no capacity available in the very best companies. And if you're not investing in those people, you might as well just buy SPY, because you're going to get better returns and you're going to have liquidity. So the only way to, really access this and get sort of those exponential returns, if you're not going to be able to get into Sequoia or Benchmark or any of the other amazing funds, I don't want to just, exclude anybody, any of those top tier funds. The best way to do that is through seeding new funds, or seeding new companies. But, there's thousands of companies. It's really, really difficult to, distinguish signal from noise, but there's these specialists out there. There's these people who spent their whole career, whether it's Arkady or, someone like Joe Wilson, who is, touching deep tech as well, but from a different angle, where he is the most well-known, most thorough person in sort of biotech robotics and the intersection of biotech and robotics, as well as a few other areas, because he's on campus and actually helping people spin up these companies from a technical standpoint. Those people are no way more than any one person could do. So, allocating to them and sort of, unlocking the returns they generate, unlocking, different capacity down the road, both in the fund itself and the companies, is a really interesting way to do this. And then there's tons of data to back it up. If anyone's ever interested, David, I can send you a bunch of links for the show notes, so people can look through the data themselves. But this is a very compelling story that's also backed up by data.
I mean, I'm curious on the underwriting emerging managers fund ones kind of thing, right? A lot of these folks, and this is why a lot of institutional LPs don't look in this direction, is because a lot of these emerging managers don't have the track record you would look at, unless they've been a spin out. Spin outs are slightly different of a story, right? Spin outs, like you take top tier fund, they were junior partners, someone junior on the team, have a deal flow track record, and they decided to start their own thing. How do you personally underwrite? And I know this is take it where you will, this is a broad question, but how do you underwrite the risk of investing into a fund one?
One of the really nice things about the universe of fund ones, or, sort of, let's call it first institutional fund, because sometimes people will have small angel funds or some investing,
like some call it fund zeros as well and all.
Yeah, exactly. Or, I technically have a fund 3 in the portfolio, but the first 2 funds, I think, together were $2 million that, that they put together, that they've rolled over time. So I think when people talk about track record, there's a predisposition, particularly in the LP world, to look at things like TVPI, DPI. Mm-hmm. And those are very useful, or MOIC, and those are very useful metrics, but those are lagging indicators of what it takes to be a successful venture investor. Because at the end of the day, to be a successful venture investor, you have to be able to see the best deals and convince the best founders to take your money.
Yeah.
That's it. And that's where DPI comes from. That's where, all this amazing economic opportunity comes from is, you got to find the right companies and you got to convince the right companies to let you invest in them. And I think that that's what people tend to forget when they look at these. They hyper fixate on these numbers as a way to reduce risk, and they're great. Like they're very useful, but it's a lagging indicator. So what we look for is, okay, basically, how do we underwrite this? How do we underwrite this person's ability to see the best companies? And how can we, extrapolate from that their ability to get the very best of those companies to take their money and take a significant money? And that's what, we differentiate that down into what is this person's unique sourcing engine and what is this person's investing edge, is how we think about it. And there's a number of different ways that we can, when we can get, if it's helpful to get into the real tactics of it, we can get into it.
Oh, one of my favorite kind of, if I might call it, Ben Ehrlichisms, is your framework for understanding how a manager's edge, because you mentioned edge just now. And to summarize the kind of trifecta, and we can include this in the show notes because I believe this was written down, but the three things you look for are: one, unique insight; two, deal flow; three, capitalizing on these deal opportunities. And I want to touch on something in particular, which is the deal flow aspect of this. And the question that you ask yourself, and I quote, I believe that you wrote this, which is, how does your deal flow match what the world will look like in the future? And I find that to be a really powerful question. So if you can help us dissect it a little bit over here, how do you define what deal flow looks like in the future? Because everyone, as far as I know, or not as far as I know, but most people I talk to, they measure deal flow as of today, not in the future.
Real venture capital, what venture capital was designed to do, right, in the 60s, 70s, right, and when Sequoia started, and the financing these types of things, was saying there is a technological change that is happening, and maybe there's some things that need to be sorted out, but there's a fundamental technological change that is taking place right now. And we can use this. It's risky because there's tons of risks. But if this technology works in the way that we think it could work, it's going to fundamentally change, the way people interact with each other, the way our society operates, the way our world works. And that's why venture capital funds are structured to be at minimum 10-year vehicles. And, some funds have been sitting around for 14 years at this point, because these companies take a long time to develop and grow. And so, what I think about is, right, like you can have the best deal flow in the world in fax machine companies, right? All these fax machine startups out there. I, have now come across one of these funds. If I would actually really like to talk with them about why they're doing it, but is the world going to be using fax machines in 20 years? Maybe. I mean, hospitals are still on them. Some legal systems still on them. I don't want to say it's not a valuable technology, but when you look 10, 15 years into the future, can you see a world where that's still a very significant part of the ecosystem? And the analysis to do is not, you're never going to get 100% certainty, but the analysis to do is, let's take Arkady, because we've just been talking about him so much, right? And he does this, I think, quite well. Is, these are technologies which have gone through significant changes and significant breakthroughs that make them significantly more commercially viable. And so, if, let's say, new energy takes over and we're able to, harvest solar energy in space, right? Or, get energy from, create energy systems that rely entirely on algae farms or whatever other amazing companies he's, looking at. Does that create a gigantic market? And if the answer is yes, and you believe that that's something that the world is going, this is your own analysis as an LP, right? This is not, the GP is going to tell you a story and you're going to have to check it and do your own analysis. But if you believe that, I think that is something, that's something to get really excited about, because, some of the biggest companies in the world today did not exist 20 years ago, did not exist 15 years, did not exist 10 years ago even. And so, deal flow on businesses or business models or areas that have already been proven out, you can make money that way, but that's not a pure venture capital strategy.
And I'm thinking off the cuff here, so feel free to call me out on my naivete, if that is something. But one of the things I'm thinking about as you're saying this is, what, like, in the world of what deal flow looks like in the future, will they get the deals of, like, let's say algae farms or something like 3 years from now, 5 years from now? The average deployment period of a fund is probably 3 to 4 years. And so is the deal flow projection of the future, like, is this deal flow going only to increase over time in the next 3-4 years? Or is it, am I now underwriting not just a fund, but a firm? So I'm expecting at least 3 funds, and that's probably an overall deployment schedule of 10 to 11 years. Are you then expecting deal flow, quote unquote, into the future on a 10 to 11 year time horizon? Or is it just for that fund in which you're investing in?
So we look at it from both perspectives. And I think this is a very sophisticated question. And I can tell you spend a lot of time in the space, because this is the question, right? Is that, are you backing someone who wants to build a venture capital firm, or are you backing a particular economic opportunity? And I think that you have to look at both. I mean, we tend to lean towards people who are building a firm because they tend to make more long-term oriented decisions, which I think is the right way to build businesses, and I think that yields better economics down the line. But there's people who would disagree on that, and they have fair points too.
Right.
So we look at two things. We say, for this fund, is there sufficient enough evidence? Is there sufficient enough data that this person can get that this type of deal flow that this person is really good at producing is going to drive some economics, is going to drive some economics down the road, right? And then you model it out. You say, okay, are we underwriting go-to-market risk? Are we underwriting technology risk? Are we underwriting, co-founder risk? All these types of things that you want to look at in terms of the portfolio strategy. That's a huge piece for a lot of this. But from a very tactical standpoint, is this deal flow something that we can see yielding some economic returns in the near term? But then there's this other bigger piece, which is, okay, if that is true, is the world going to continue to move in this direction? Right? I think, like, for example, there's a question about crypto, right, and Web3 technologies, that there was a lot of value creation, a lot of sort of wealth generation that was done by a lot of crypto companies, but now there's a question of, is the world going to continue to move in a decentralized way or not? I don't have a particularly strong viewpoint on that, which is why we haven't really allocated to a lot of crypto. We haven't allocated to a crypto specific fund, and I've been uncertain around that, where it's like, I don't know, and I don't have a sense of the magnitude of, or can get to any sort of certain about the magnitude of the likelihood of that happening. Again, there's people out there who are very smart on this topic and who might make a lot of money doing this. It's just not something that we were able to get comfortable with. So, but to your question about sort of long-term time horizon, that's the analysis you do there. Say, okay, now that we've reached comfort with this strategy, right? Because I think that's sort of the first step, is like, do we believe that this strategy deploying in the next 3 to 4 years can yield economic returns? Then you say, okay, if we're going to underwrite this firm, because we don't, we come in early, but we want to be with that person for as long as possible, because we're backing people because we believe in them. Do we believe that this sort of has the juice to continue to work? And we've definitely passed on people that, we've said, look, there's maybe some economic opportunity here. We get fairly comfortable with that, but we don't know, that this is going to continue to grow and be projected. But we have not. I'm just trying to think. Have we done the opposite? No, we have not done the opposite, where we're unsure on the economic. But both pieces need to be. I guess what I'm saying is, let me stumble over myself for a few more minutes. What I'm trying to say is, both pieces have to be there from our perspective, and I think as emerging LPs need to look at it and say, look, do I want to write one check into one person, or do I want to continue to invest in this person and their companies for a long time? And that's two different exercises.
I want to talk about how you say no's, because this is going to be a more long-winded question, so I'm going to have a little preface before it. But a great mutual friend of ours, Tom White, once told me, you are a man of your word, and you always do what you say, no matter what the circumstance. Which, to interject my own kind of train of thought, Tom is an incredible human being and probably one of the greatest underestimated writers of our current generation. So for those who are curious, would highly recommend checking out his Substack, White Noise, spelled exactly how you would imagine it. White as in the color white, noise as in signal to noise. But if you're looking for a place to start, I would recommend starting with his piece, Tetris with Word and Phrase. But I digress. So as inspiration from Tom, how do you personally think about promise fulfillment? Because we often say no to funds more often than we say yes to. And how much of that impacts the way in which you build relationships today? And to buy you some more time here, Ben, you wrote back in 2022, you promised the world a few things. In fact, I think you promised the world 5 things, which was 1, I will respond to your emails within a week. 2, I will define clear next steps at the end of every meeting we have. 3, if you aren't a fit, I will tell you and deliver written feedback as to why. 4, if you could be a fit, I need to see more, I will tell you and deliver written feedback as to why. And then 5, if you are a fit, and I will be a low friction LP and will do everything in my power to make your fund a success. I want to talk about number 3, which is if you aren't a fit, I will tell you and deliver written feedback as to why. What are the principles that currently govern your mind when it comes to saying a no to a fund manager that you've had a conversation with?
So I think it comes from having had to raise a lot of money over my life. And there, and actually this is something that Tom and I talk about, which is a no is infinitely better than a maybe. And these are things that I aspire to. And it's possible, I have definitely fallen flat on them at times, and I feel really, really terrible about them. And there's times when life gets really busy, like when you adopt a 4-month-old puppy on a snap decision, which I'm currently dealing with right now.
A beautiful Irish doodle.
But a beautiful Irish doodle. She matches my hair color, which was very important to my partner. I think the real thing that I thought about, which is, what are the things that would be important to me? What are things that I would want to know, and what are the things that I've learned from the most? And, people who have taken the time to write even just a couple sentences, hey, it's not a fit because, we do this, or we're looking for this, is incredibly helpful. Because not only does it, make me understand why they passed, but it also helps me build a relationship with this person over time, where I can say, look, you said you wanted real estate hedge funds. Well, my friend's raising a real estate hedge fund. Let me send it to you. And then not only do I get to help you, I get to help my friend, and we're all going to be working in these industries for the next, 20 to 40 years. So, we should all be helping each other anyway. So when I receive those types of things, and when I receive those types of messages, it always really helped me. And so I said, that's the type of LP that, I would like to talk with, and that's the type of LP that I want to be. I tend to say that a lot of the pass reasons, like when it's just a straight up pass, are usually pretty simple. We tend to prefer more concentrated portfolios. Sometimes people are a little bit more wide ranging. There are areas that we just can't reach conviction on, or can't really lean into. I mentioned crypto is something that, we've just not been able to build conviction around. There's some other areas as well that, pure play pharmaceuticals, or, pure play drug discovery is not something that we really want to get into. So, and sometimes it's just that. Sometimes it is a little bit more nuanced as well. So, so I've passed emails that have taken a lot longer to write than, sometimes investment memos, because I really care about the person. But, it's a human touch that I do try to introduce, because it's, how I want to be treated.
I love it. Are there archetypes of deals or fund managers that are hardest to say no to?
Yes. They're also the ones that are hardest to build conviction on,
Right.
As these things go. So, and the story usually goes like this. Hey, I'm X operator, or I was a venture, I was a partner at this amazing venture fund. I have an amazing network, and I'm going to invest in a bunch of different areas. I'm going to invest in a bunch of different stages, but because I have such an amazing network, I'm going to generate a bunch of returns. And those are so hard to say yes or no to, because at the end of the day, you have to underwrite that person's network and that person's ability to pick founders from a bunch of different areas. And there's people who have made tons of money and have had tons of success around these types of things. And then there's other funds that have completely fallen apart because they don't have, there's tons of thesis drift, and they just happen to be investing in the wrong places at the wrong time, into founders that were building at the wrong place at the wrong time. So those are incredibly difficult funds to underwrite from our perspective, because oftentimes there is somewhat of a limited track record. there's not a way to project into the future what types of things are going to be in the portfolio. And for us, since we're building a portfolio of funds, there's always the likelihood that you build, that this person would build a highly correlated portfolio to another one of our funds, which is something we really want to stay away from. But at the same time, Eli Gill has done a tremendous job, and that's kind of his world. And some of the earliest venture funds were exactly that. So it's a really, it's a difficult situation. We have not done a single one yet. There's a couple that we're still watching very closely. But it's a really, that is a really compelling and really difficult to underwrite story to hear.
You mentioned earlier that you've invested in 7 funds already so far, and you're only going to invest in more. Are there sectors, industries, geographies that you are looking less of deal flow from just because you may be over allocated to those industries? We mentioned deep tech, right? And maybe deep tech is also broad, so there's a lot of things in it as well. But how do you look at the underlying portfolio in which you have, which is like the startups, the assets themselves, not the fund managers, like pass through and all that? And if, let's say, I'm making this up, I don't have the details here, but of those 7 funds you've invested in, let's say 3 of them are consumer, does that mean for the next few funds you're just no longer looking at consumer because you may be over allocated in your portfolio towards consumer?
The way that we model our portfolio, and the way that we look at it is we're looking for concentrated, non-correlated bets. Right. So when you use these, there's a tendency to use words like deep tech, climate tech, consumer facing, right? These are very broad, and actually there's almost infinite strategies underneath each of these umbrellas. And I've seen, we've looked at almost 1,000 different funds at this point, and there's still plenty more strategies to deploy. What I'm looking for is this, what's the underlying risk in this portfolio? What is the upside of this portfolio? And is this highly correlated with a different strategy in the portfolio? Because early stage venture, from a valuation standpoint and from an economic standpoint, is already extremely correlated. I mean, biotech is really correlated to materials tech, which is really correlated to, B2B software, right? So because you have this sort of overarching, the market moves very, very close together, much more so than public markets. We're trying to reduce that. We're trying to reduce where we can reduce, right? So that's sort of like downside protection. And then the upside is, if this fund does really well, are they owning significant amounts of these companies where the fund can pop off, sort of like how you view a pre-seed or seed investment. So, we have two, you could even classify 3 of the 7 funds are actually quite technical, could all be classified as deep tech, but they're getting us really different exposure, right? Arcadi is different than, different than Joe Wilson, is different than another fund, which I think is still in stealth. So I'm not going to say their name yet, right? They're all betting on technology risk. They're all sort of iterating at the intersection of sort of science and business models and technology, but they're all really different strategies. And there is a 0% chance that they would invest in the same type of company. And so that's what gives us comfort there. I will say the one thing that people need to be cautious of in this area is that I don't want to be taking macro bets on whether software, whether materials, whether bio, whether climate is going to be the most successful area in the future. Because if you start dividing it up and saying, 20% into deep tech, 20% into consumer, like you are making a pretty big macro bet that I don't know. I know that I am not sophisticated enough to make at this point. And I don't think that anyone can be sophisticated enough to know that. So what we're looking for is amazing opportunities, amazing funds, amazing people with all the characteristics that we're looking for.
That makes a lot of sense. And I might say I wouldn't call it pushback necessarily, but the only thing I've observed of people who have built these buckets that they're really excited about are maybe like family offices that are not driven by mandates or what the future would look like, but are driven more so by these are things like impact or green tech or a climate tech that they're personally as a family interested in seeing the future of. And it's not completely
Absolutely.
correlated with financial return, but I mean, the sense that you do, when you invest in a fund, you still want more money back than when you put in, but it's more so this is a personal motivation of the family or individual that they just want to see more things in the world of.
I think that's 100% right. And I'm lucky enough to have LPs who have trusted me with some of their capital, and I promise them the best returns that I can possibly get them. and that's that's the lens that we look at it through. And I think that there's a lot of really great work that family offices, foundations, endowments to a certain point do in those areas. And I think that what they're doing is they're saying, we are willing to take this macro bet because we believe that this is where the world should go. If the world actually goes there or not is sort of less important, but we believe that this is really where it needs to be. And I really, that's a really, really phenomenal way to view things. And I'm very happy to have, more of those people in the world, because I think
And I think if I were to summarize, and Ben, let me know if I'm putting words in your mouth here, but there's a strategy of where the world will go. And there's a strategy of where the world should go. And those, depending on your motivation for allocation, will look different from each other.
Absolutely. I hope that, from as a person who, has hopefully many years left on this planet, I hope they end up being the same.
Right.
But, I think you have, from a portfolio construction standpoint, you want to be thoughtful around, that.
I agree. There's a great tweet going back to the world of just quoting things that we were finding. There's a great tweet by, I want to say Josh Wolf, if it's not like Bilal, his partner. But there's a tweet that talks about incentives versus intentions versus incentives, and that there are people with like natural intentions of, and I'm like, I might be jumping a couple leaps of faith here, but family offices, endowments, foundations are more driven by their intentions of where they want their world to be. And then there are certain fund to funds, LPs with mandates that have incentives of delivering financial return. And not saying that's necessarily a bad thing, but the motivation behind the organization looks different as well.
Would I ever invest in a fund that, is trying to sell cigarettes to children? Absolutely not. But would we invest in a climate tech fund purely on the basis that that we believe that climate change is one of the most, existential risks facing humanity? Potentially, but there also needs to be all those components to make sure that we're also making money as a part of that. And so that's sort of the nuance there, is that we're not, we're financial returns motivated as a mandate, and that's what we have promised. But we also believe that, there's a way to create good positive returns and positive impact.
I agree. To kind of go in the theme of nuances, things that might warrant a no, that not necessarily is thesis and strategy itself. One thing we talked about in our pre-chat here was the world of governance. So I want to touch a little bit on governance. And in our early conversations, you mentioned that might be some reasons, things that like people don't typically look at in term sheet or LPA, that is actually of quite import to LPs and probably should warrant a second degree look. So to keep it pretty broad for now, we can dive deeper where it makes sense to. How do you think about governance today, and how much of that goes into the underwriting process before you invest in a manager?
LTSE is a very important governance platform, right? It's a stock exchange. It sets the rules for public companies, and it does a lot of work sort of in the late stage private markets as well on the governance standpoint. So this is something that I've been, around, a part of, in with for a very long time. And Eric's sort of one of the big leaders on this space, particularly around AI. For a decade at this point. And so, but a lot of times, startup founders, managers, when they hear the word governance, it's like they're like, oh my God, this means like my lawyer's going to charge me another, $5,000 to do something that will never come up. But really at the end of the day,
they're going to charge you per email.
What is, yeah, exactly. Those lovely 0.1 hours for research. It's like, you're billing me for 6 minutes. What? Oh yeah. Love my law firm. They've never done that to me, but I have seen it happen. What governance really means in this case is who makes decisions, and who is the final decision maker, and then the process by which decisions are made. Right. So when you're building a fund, if you're a solo GP or early stage GP, you need to have these things ironed out. And as an LP, I think everyone needs to ask, because there's a couple of very important questions, right? If you're investing in a solo GP fund, if that solo GP gets hit by a bus, what happens? Right? What happens to my money? What happens to my obligation? If there's two GPs, how do you make a decision? Because there's two of you. Does it have to be unanimous? Does it have to be does it have to, does one person have the right to do it? What are the rules that govern it? And what are the actual documents where it's written down that says the rules that govern it? There's actually a great book. I think it's called Reframing Finance, or I think that's what it's called, by Ashby Monk, where he talks about investment committee design and investment fund design at pension fund level. Ashby's amazing, and anyone, he's got a phenomenal number of podcasts, and everyone should go listen to all of his stuff because he's really, really good. And read his books because they're really, really interesting. But Ashby talks a lot about this on the pension fund level, which is obviously significantly more complicated than it is on the emerging manager fund, but it's still important to emerging managers, because all of these decisions around, who operates the fund, who's going to be the admin for the fund, how do you make decisions around when to send out wires, how do you make decisions around distributions, like these are all things that feel very far off into the future. And it feels, I'm going to quote Eric here, it's almost feels like it's too early, and then one day it's too late, right? For example, on the investment committee standpoint, where it's like, oh, well, me and my partner, we've worked together for 10 years, we don't disagree on things, and when we do disagree on things, we can work out. Well, imagine a situation where you're sitting on a company, and let's say, let's use a very popular company, right? You're sitting on the next OpenAI, right? And one of your partners is so 100% into it, and one of your partners is so 100% against it. What do you do? And maybe it's three, maybe you're on year 3 of your 4-year deployment. What do you do? It actually might blow up the fund at that point. And so you really need to iron out all these details up front. And to be clear, when I first meet managers, most of the time they don't have these details ironed out, but by the time they get to their first close, they do. I work with them on getting it done, because these are things that are non-investing decisions, or not sort of like the discipline of the art of investing, that can impact returns in significant ways.
Going back to the question, or like the comment about, like, let's use the example of OpenAI. One of your partners is extremely for it. One of your partners is extremely against it. And this might be hyper specific an example, so feel free to take it, abstract a couple layers. What are examples of good answers to that question?
The best answer in these situations is to have a answer, right? Because I don't, is it that every single decision has to be made unanimously? Well, that's how Sequoia operates.
Right.
But then there's also models where you can have the champion model. I think Benchmark operates that way, or
right.
Maybe it's BVP. But there's funds that have been very successful in the champion model. There's funds that have been very successful on the unanimous level. I don't think that it matters so much the exact mechanisms, particularly in the earliest points when you're just starting to build your fund. I think that because it's going to change over time as you build a successful firm. But you need to have an answer, because the situations are going to come up. So, for example, I've backed a 2GP fund, and they say, look, we run a champion model up to a check size of X, and then once it gets above X, we have to have unanimous agreement. And that's really an option. There's an option where it's like, nope, we can champion 5 deals a year, right? And then otherwise it has to be unanimous agreement. Or we've had funds that have said, no, it has to be complete unanimous agreement. All those are appropriate and fine, and I think make sense, but you need to know the answer by the time that your LPs have given you money.
This is going to be a terrible example because I'm not remembering the name of the individual that said this, but we'll put it in the show notes as well. There was a podcast I was listening to recently. It was on Venture Unlocked with Samir Kaji, and they were interviewing someone at Khosla, which the only person I'm thinking of right now is Keith, but it wasn't Keith for sure, but it was someone else at Khosla who said this. And I'll link it in the show notes. So in case people can't find it, I can go find it for you. But what they said is there is an answer I find very interesting. Not sure if I completely agree with it or not, but I find interesting nonetheless, is the consensus model. There's conviction models and there's consensus models. Going back to there's champion models and there's unanimous decision models, right? In the consensus model, when everyone needs to agree on a deal, what happens is the person coming in who did the diligence on the deal, had the conversations with the founders, immediately goes into sales mode. And because they always go into sales mode, they're only thinking of the most positive things about the company, and they may be blindsiding themselves when getting into that pitch mode. And so for that reason, and I will say this person at Khosla, it's killing me that I'm forgetting the name of, said it much more eloquently. But in that world, it is better that we don't go for consensus models and we go for, in Ben, your words, the champion models, because at that point you have people to check your blind side and you are staking your own reputation, social capital, the amount of capital you can deploy against that. And it is on you, even though it is an overall COSLA decision. And that's not the only firm that has that kind of model, but I find that perspective to be rather interesting.
As firms grow, these are the questions that get even more and more complex. And you just want to make sure, you want to start out in a place where you're thinking about these things, because that, like I said, it's, and like Eric says all the time, it's going to be, these are the things that are going to be too early. And then one day it's too late and you end up in a bad spot.
Ben, as we get into the back half, and as we get ready for our curtain call, there are a couple questions I want to just ask you about that aren't necessarily about venture, but I kind of just enjoy asking because it paints the humanness behind being an LP as well. And I kind of want to talk about the role of serendipity in your life, right? So from meeting the girl of your dreams the next day after you graduated early from college to your dad finding you in a liquor store at St. Patty's just before you hit the 2-0 while he was buying milk, to getting an offer from Eric Ries took some time to decide. And not even a few hours later, you go to your entrepreneurship class and your professor tells you the holy Bible if you want to read and learn anything about startups is the Lean Startup. I'm curious for you, what is the role of serendipity in your life?
I knew you were going to ask this question. And it's a very hard thing to answer because, I every day I wake up and I cannot believe where I end up. You always think about yourself 5 years ago, would they be proud and overwhelmed? Would they be proud of who you are? And I can't, myself would absolutely be proud. They'd also be incredibly shocked. Oh my God, things are going really well. How did that happen? So, I think that, David, I promise I thought about this question, but it's just a very hard question for me. Because I don't believe that, there's some spiritual being, I don't believe in the traditional spiritual being telling you that you need, sending you signs or things like that. But I think that there are times when your senses get very, there are times when you become very sensitive to certain things, and it's your body's biological response that something is around the corners. There's something out there that might be really good about to happen, and your body has sort of a natural reaction to, or something really bad that's about to happen, and your body has a natural reaction to start picking up on different things. Right? It's like, when you hear, when you go back and you hear a song that was, around for 40, 50 years ago, and all of a sudden you start hearing that song everywhere because it's really famous, right? It's those types of things where it's all of a sudden you're paying attention to different things. And so, I've been very lucky that there's just been a lot of very serendipitous moments in my life where it's like, oh my God, I couldn't have, planned it out any better. But at the time, it didn't feel that way. It felt like I was jumping from place to place to place, and I was working really hard and pushing myself to go do things, but it didn't feel like I had a clear trajectory. I'll put it this way. I've been very lucky. I've worked very hard. When I look back on it, did I ever think I was going to end up in this position? Absolutely not. Am I so happy and so overwhelmed by the people who have trusted me and helped me get to this position? Absolutely. And I don't really think there's anything else to say about that.
Maybe last question over here as before I let you go, just because I know we're short on time. How would you describe Commisso Brothers to someone who's never experienced the magic and terror of ordering a sandwich at a little joint in Toronto?
For those who don't know, Commisso Brothers is this small, Italian grocery sandwich joint in Toronto. And, it's been blown up a number of times, and there's all types of dubious connections there. But just imagine for yourself, you go into this beat up old parking lot, and you're kind of in this weird neighborhood. You walk in, it's dirty, cracked cement floors, and there's just weird shelves. And you walk up to the counter, and the guy behind the counter is meaner to you than you ever thought was possible in a short interaction. It's dark, it's dingy, you're kind of getting yelled at. You say, hey, could I have this? And he goes, I don't know, could you? That type of reaction. They just do not want you in there. And then you get to the cash register, and it's $4. So cheap. And you walk away with the best sandwich of your life. So they make it as possible. They make it as difficult as possible for you to get in there. It's terrifying for anyone who wants to, learn more about the history. Just look up Commisso Brothers Toronto. You'll see a bunch of really interesting stories about it. But I was lucky enough that my dad, from a very young age, was taking me there, and sometimes was not telling my mother that he was taking us to this store. So
Yeah, hopefully your mom isn't watching this after. But it reminds me of like MMORPGs when you're allocating stat points, and instead of customer service, they've allocated all their stat points into the flavor and the food themselves. All right.
Oh, exactly.
It's exactly what it is. Ben, this has been such a pleasure. I would love to go longer, but we're both short on time here, so I'm going to let you go. But as a last thing, where's the best place for people to find you?
Best way is to drop me an email. My email is ben@momentumcapital.xyz. I do respond to everything. If I miss you or you get caught in spam, please feel free to follow up. You're also welcome to reach out to me on LinkedIn or Twitter. I do not check those DMs that often, but I do try and do a scan every once in a while.
Ben, I gotta let you go. I've enjoyed every second of this. I knew I was going to enjoy every second of this from all the testimonials you've had and all the good friends you've had and mutual friends we've had. So thank you so much. And we'll talk soon.
Thank you, David. I really appreciate it. We're looking for concentrated, non-correlated bets.
I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Khosla Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, MoEngage, FarmWise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. Hey Superclusters fans, David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.